as 0.7, 0.8% on futures. Now it's on 0.39. So let me pull up. I've got a futures workspace here. Give me a moment. Let's go to this futures workspace here. Yeah, so let's go into, here's a 1 hour chart. This would be 4 p.m. So 4 p.m. open back up at 6. I mean, 67.24 in futures all the way down to 66.81. There's a 40-point move in futures, and we've come back. So we're still down from the start of the session. I mean, you can look at it here on the smaller time frame. We got a lot of ugly moving averages, but just bear with me here. So all this was futures. So market just sold off aggressively. I'm guessing a lot of that is government shutdown, and then we bounce back. So right now, I think this is a classic kind of coin flip type day. Posture is set right here, high to low. We're sitting right in the middle, and the market's going to have to decide. A couple ways I'd be watching this for today is if the futures market, this is the black line is a VWAP. If we get below the VWAP, then we're probably putting pressure into the downside. If we stay above it, then this market just keeps climbing back. We'll see. I mean, opening 0.4% lower. I do have one broken wing butterfly that could be looking pretty good for a profit today. This should be the 6,700. That was a Friday expiration. If we're going to open up about 0.4% lower on the markets, let's get that to, let's see if the SPY is gapping as well. So that's down about 3 points. So that is 0.37. I'll benchmark that. So about 3.7% on the SPY. So let's get a rough estimate here on the SPX. If we're opening 0.37, that puts us down to about 66.63 at the open. All right, so write that down, 66.63. And I'd like to see prices stay below 6,700. I do have a broken wing butterfly that is my pin price. That's my sell call. So ideally, I'd like to see price not being above 6,700 by Friday. Hopefully that's the case. Hopefully we're going to see a bit of a correction. So if we open lower today, stall around, can we sell back at the highs from the close yesterday and proceed lower? I mean, let's get our measurements. So yesterday's close was right around 66.88. So I'll make this an update on our indicators. So this is the daily profit indicator, 66.88. I can recenter. There we go. And we're looking to open up right around the 50% ATR. So I'll make a reference here inside of my tracker. And a couple things. So I'm taking screenshots now every day inside the daily profit play. There's a tracker that I'm watching for the ATR levels, because yesterday all we had price do was basically sit just above the 50% ATR, but not above the 100. It was also a late day surge. This market did absolutely nothing all day, but it did what I expected, which was actually gave us some flow at some point, and it was an afternoon flow. This thing didn't really start coming alive until 1:30. We broke the highs here after 2 p.m. This was the 66.60 high we needed to see broken, and it proceeded up. Now, this worked out two ways. If you stayed in the reverse iron condor yesterday, that paid out full profit. I got out for a small loss because it was already 2 o'clock when I made the decision. Of course, it's 2 o'clock, and by 2:10, 2:15, the market's up to these highs and it proceeded to break higher. That's on me. However, my risk was 85 cents. And I also had a trade running that if we stayed above 66.30 yesterday, I made $410. So the trade-off was I'll sacrifice the inverse iron condor, which obviously I don't want to lose, but I took that small sacrifice because the dead zone wasn't sagging all the way down to the middle. And I offset that with a nice win. That was through my waterfall income trade. We actually hit a profit trap on my waterfall income. We had a call condor trade we took. That was the 9:30 expiration. And then we also have the bear call side of that trade rolled out a little bit farther. So summary is this. Had a nice profit trap win on waterfall income. Took a small manageable loss yesterday on daily profit play. The inverse iron condor was the right decision. It just took all day to move. And I guess as I started the live session, the live masterclass, I just made an executive decision. It was a small manageable loss. And if it was just going to stay there for the day, I'm like, well, this whole idea of the government shutdown, looming and the market might just be going sideways until it's official. So that's why I bailed on the trade. But we did, in fact, have the end of month, end of quarter, and it did give us direction, which is what I wanted yesterday. That's what we got. So I do want to ask if was anybody in the daily profit play reverse trade yesterday that actually hang on to it. Whether you took the 610, 615 credit, close it out for 550 debit, 540, 530, let it go to expiration, grab the full dollar, $10, 15. Yeah, Ted says small profit, got at a break even. David, okay, good. Good. Nice. Nice, nice. Craig, right? Let's see. Hang on, I got two. Yeah, Craig, welcome, dude. Glad to have you. Lynn took a profit, sold $20 profit, good. Got out of 520, Catherine, awesome. Brett said closed at 10 cents, even better. Fantastic. Larry says bought an E-mini put last night. 560 bucks gain middle of the night. Yeah, that's not. So did you actually manage it through the middle of the night? Because I mean, it's given back a decent amount of. It's given a decent amount back as we approach the markets right here down, 0.4 versus 0.8. So anyway, that's a great trade. One thing I'm looking at for today is I'm looking at the VIX. I think if you zoom out here, obviously the VIX has had its moments where we've had some pretty scary stuff, right? This was Liberation Day. This is your Volmageddon event in summer of last year. Then you're going into some ventilations in, we had a pullback. We had about a 10% pullback in 2023 before the market found its footing in Q4. We had a run up into, I mean, all these are running up into the 30s. And in 2022, we had lots and lots of spikes up in the 30s. Right now, the VIX is at 16.7. I still think the VIX is it's suppressed. It's no joke. It's suppressed. But I do think that it potentially justifies or warrants some type of run into like maybe the 20s. If we get into like the mid 20s, I think I could turn a pretty good profit on the VIX. So let me do some numbers calculating here. If we did a delta, this position is going to be a little tricky. I don't know how well this is going to pay, but I do know it's not going to cost me that much money. So what I'm considering here is if I went out to, and I'm going out pretty far. I could go out way less time. It could be dirt cheap. Let's see here. Maybe November. If we're going to do it, it's going to be cheap in November. So if I did November, let's say, sell the 16.5 and I buy this, for 280 bucks. So for 280 bucks, if the VIX spikes above roughly $18 or $19, I will make, hopefully delta wise. This is a 78 delta. So, if we go up to 25 or 30 on the VIX, that should become a close to 100 delta. And maybe I can grab, I don't know, $5, $6, $7 credit if we get that move. So what I'm contemplating here is I'm not just going to do a synthetic long on the VIX because that would require about $2,000 of buying power. What I'm going to do is tighten this up where I can get this. This is for 329. This is for 312. I don't know why the values are, a little bit less buying power here. So 379 for $400 for 400. For 450 bucks. This isn't bad. So for 491 or for 451, I could be wrong, but I'm looking to see, is there a major VIX expiration that for $2.91, could I get the VIX to run with unlimited profit? So if we get a big spike to the upside, I could turn this into whatever the VIX gives us. If we spike up to 25, that's enough to take some profit. We spike up to 30, enough to take some profit. I could also just put in a trailing stop loss, So I'm not capping my upside that way the time. If we see any type of decline in the market from now until the middle of November, this should be a pretty cheap trade. So I'm officially going to take this trade. This is going to be part of my crash insurance masterclass. That's where the alert's going to go officially. But you're here for my daily profit plan, so I'll take the trade with all of you. I'll give you the details of it and how it's going to work. Okay. But what I'm looking at is I think I need to have at least some type of play on the VIX. If I mean, and I'd like to go out longer, but I just think this is a pretty cost effective way to, I mean, if I wanted to pay this much money, I could also go out a lot farther. Um, so let me kick that around for a second. So if I go to November 19th, so this is VIX 1119, I would buy the 16.5 call and I'd sell the 16.5 put. If I did that by itself, that'd be a synthetic. But what I'm going to do is I'm also going to buy a 14.5 put in order to create a spread. I don't want to own the VIX. I don't want to be assigned the VIX. I don't want that type of risk. I want to cap the loss at 491. Now let me go out a little bit farther here. And if we took this thing all the way into like March or April of next year, if I were to sell the 16 and buy and then create this, I'd have to go a little bit wider on the buy power. So this one's a max loss of 677. And now my debit is, almost $6. So it's obviously way cheaper to go way less time. But this is also a very large delta. So I mean, this would be like a $16 long call at an 85 delta. If we spike up to if we get to a 20, then my 16 should be trading for close to like 90, 95 delta, which means that for every dollar in VIX, I'm going to get hopefully, close to 85, 90 cents of profit on that trade. That risk is 677. If I went up one more strike, okay, but that break even puts me up to like 22. I don't know. I think I'm going to take a quick stab at it. I kind of hate the zombie market. This lack of pullback stuff is kind of driving me crazy. We had terrible ADP numbers today. We have a government shutdown going on right now. We might not even see non-farm payroll on Friday. So all these things are potentially happening, right? But anyway, I just want to look at this from a synthetic. If I buy the 17, sell the 17, I mean that we need to get above 20. Max risk is three. I'm going to take this trade. Just over. So the max risk is 352, or the max risk is 381. I'm going to take this trade here for a max risk of 381. This gives me a dollar wide, brings the debit down to under $2.90. Let's see if this will actually fill. So it's a pretty wide bid mid ask. Let's see where we can get this thing filled. I'm going to try a 280 right now. This is out to November. Let me see if this will fill. All right, so 280 not filling. Let's try 285, just above the mid. I'm going to penny this thing up, hopefully 290 or less. And if I get filled, we'll share the trade. This will officially, I make this an alert for my crash insurance, but you can have it as a little bonus today. Again, what this is this is a long VIX play. It's a bit of a hedge. I'm looking to see if the market is going to go, if the market goes down, turns risk off a little bit. Do we see the VIX spike up into the 20s? If so, that should get us paid. Hopefully getting paid. I'd like to say we can turn at least 100% profit on this thing. 290 not filling. Jeez, come on. I mean, the ask price is just above $3. So I'll keep going. $294, $295. Come on, dude. I'll just keep. I want to get filled, but let me just go penny by penny. See what happens. Okay. Catching up all those profits there. Very good. Brandon, $70 profit. Very nice. 510 for Brett. That's a great close. 665 on daily. Yeah, I mean, Dave, it was a perfect day for daily profit play. Kent doing some education. I see that comment, man. Gold star me. High five to Kent. Put credit spread, because that's just defined risk. Put credit spread, you're going to cap your upside I'm looking for unlimited, right? I mean, if I'm going to go long VIX, I want the VIX to spike up. I mean, if you were long the VIX during Liberation Day, you had like a 10x return. So like a credit spread is also time based, where if the VIX spikes up and reverts, you're not going to get paid on your credit spread like you think. Okay, and if you're long shares of UVXY, that thing is a nasty reverting instrument after 30 days. So I've got to trade it a little bit differently. Okay. I should be able to get in this trade, or else it would say order filled. We'll see. Because it would just say like open at session. Anyway, let me put a pin in this. I'll put this in at 285, and then officially at opening bell, let's see if this will fill. But it's not telling me that it won't fill, because usually when the markets are closed, it'll say we'll fill at the next session. So I'm trading. You can trade VIX or you can trade VXX. I'm going to trade the actual like SIBO VIX and just trade a synthetic. So I'm going to try to get in for 285. We'll have this. This will be something I at least look at for today. I mean, the VIX is happening right now. We should be able to trade the VIX. It shouldn't be an opening bell, closing bell instrument, because the VIX is happening right now. That's 1668. I'm not sure when this returns live, but it's 1669 right now, live price. And we've got opening bell in about 8 minutes. So the expiration that I'm seeing is for the VIX. I've got an AM expiration on November 19th. So I'm looking at the synthetic 17. So I'm gonna sell the 17 put, buy the 17 call, but I'm also gonna add a 16 long put so I can cap the risk. Okay. So I'll see if I can get that thing filled, and if so, then I'll put it in the Zoom chat. This will go out officially for my masterclass, or my crash insurance masterclass. Okay. All right. Let's talk some numbers here on. Let's see, my VIX at 16.7. Let's go SPX here. There's my daily profit play, and I'll pull over my workspaces. So we shouldn't see prices going higher than 67.50. We shouldn't see prices going lower than 66.20. The plus minus on the day. Plus minus on the day for October 1st is a 30. So we got a plus or minus 30 on the day. IV rank is a little bit higher. Implied volatility is up to 20.7. So we're likely opening. I mean, futures is still down about 0.4%. I wouldn't mind, trying to sell the 50% ATR. I mean, that's above all-time highs. I don't think we're going to get there. We're likely going to be gapping lower based on the open and future. So if we gap lower, go plus or minus 30 points, I mean, I wouldn't mind trying to do something like this. If we gap lower and we pull back into the highs yesterday, maybe trying to sell either the highs yesterday or selling up to the 50% ATR. If I can get $1 on that 50% ATR, I'll take that trade. And then on the put side, I'm going to try to go to the extremes of like the VIX box. So this would be, trying to sell some put spreads around the VIX box lower the 150% ATR. Okay, David, you asking about the VIX? It was a November 19th AM expiration. So I don't see the 25th. Whoever's mentioning that there's a 25th expiration. Rick says there's a Thinkorswim November 25th AM expiration. That's not what I have in the VIX. I have a 19th. That should be the monthly expiration. So the Novembers, we have the 21st in the S&P, but we have the 19th for the VIX. So the VIX is usually a Wednesday expiration, and then you have your Friday. So the 21st is that Friday expiration for the S&P. So you have your AM on the 21st, your weekly on the 21st, and your 19th is going to be that Wednesday VIX. Yep. Okay. All right. So today, plus or minus 30. Reference point at the close yesterday. We're going to gap lower. I'm going to look to try to do some, bear call spreads out of the way. And then to the put side, I mean, we can always just take our standard daily profit play if the market's caught off guard. But if we're going to be sliding lower, I mean, if we take out lows, I just want to make sure we're not getting into like the big levels. So if I do a put spread at the 150 or put spread at the 200 ATR, we shouldn't close below those levels today. So just that's my 2 cents. Okay, let's crunch some numbers here. We have 5 more minutes. What's kind of crazy is look at this gamma level. There's a ridiculous gamma level today at 67.50. I don't know how they're pulling that today. Like, how are flows showing 67.50 when we're going to open about 0.45% lower? That would be a ridiculous directional move if that's the case. We open up 0.45, that's 66.59. You mean to tell me this thing's going to go up 90 points today? I don't know, man. I mean, this is just data flows. Like, there's clearly something going on in the options market, but that seems like an unrealistic target for today. So let me check a couple more things. So I've got my dynamic trend here. It's not credit, and be a debit, and the trade's not filled yet. So when I get filled, I'll make it an official post, but it's going to be a 285 debit. Let me bring up dynamic trend. Okay, I guess it's still stuck from yesterday. All right, let's try this again. There we go. Okay. So pre-market. So I've got the positive negative gamma around 66.60. We're going to be opening there pretty much today in the open. Stickiest level 6,700, not 6,750. I don't see that 6,750 on my charts. So this is real time flows. That's one of the few discrepancies I see between Tanuki Trade has a 0 DTE. This is my dynamic trend. Yeah, I mean this will all change in real time. But once we open lower, I'm curious where this goes. I'll make sure this is all 0 DTE. So ultra short. Yep. So we're 0 DTE. And positive negative gamma pivot. So if we're above 66.60, that should maintain kind of this, force support in the market. If we're below 66.60, then that brings in the negative gamma. I would just want to be focused on bear call spreads if we're in negative gamma. Negative gamma means more downside, faster. Faster falls, higher volatility. But I think the annoying thing today is I still want to do bear call spreads, but we're going to be opening 0.4% lower. So be careful on just position. I think the safe thing is setting trades possibly up towards the high of the close yesterday, or setting up to the 50% ATR, like 67 to 67.10 is not a bad spot to be selling today, especially if we're going to open up right around the 50%. So we're going to open up probably around or at or even through or lower than the 50% ATR. So we either bounce hard, but even remember the plus or minus on the day. If we open here, I mean, we have to go 47 points up. Plus or minus is 30. So that really shouldn't be reachable. But obviously the market does whatever it wants. Schwab shows 243 mid on VIX. I mean, it's good. What's the bid ask though? Is it pretty wide? All right, we have 1 minute. Let me get some numbers. VIX is 16.7. I'll calculate it here. 16.7. That's over 1%. So 1.04. I mean, so 67.50. That's so far up there. 67.55 top and 1.04 around 66.20 bottom. All right. I'm getting filled on the VIX at 285. Okay, so I did get filled at 285. If it's cheaper, I mean, take it cheaper. But let me see. That'd be all symbols. So my VIX got filled here. I'm gonna crank this trade out. Let's go similar. I'm going to try to get this in for everyone's accounts really quickly. All right, getting filled across the board. Just give me a couple minutes to get these trades in on the VIX. Getting filled at a 283 debit. Canceled. There we go. Okay, so I'm focused on the VIX first, and I'll get our trades in for SPX here in just a little bit. I think we have time on SPX. I'm not worried about it. I want to see, like, we gapped lower. I just want to see what price does. Okay, still working here. Okay, almost done. Last account. There. All right, so VIX trades in. I'll type this in the chat. I'm going to start looking at my trades for SPX this morning. So the trade that I took on the VIX is, I'm typing this in the chat. This is a 11/19 expiration. It's the AM expiration. I am selling a 17 put, buying a 17 put, or I'm sorry, buying a 17 call, and I'm buying a 16 put, $2.85 debit. This is a defined risk synthetic long on VIX. Ideally, if VIX spikes to 20, 25, 30, this should pay well. It's just a pretty inexpensive hedge. The most I can lose on that trade is $385. So I'll stomach that risk for something that could pay me potentially, $1,000 or $2,000. Depends on the timing. If we have a crazy move, it could be thousands of dollars, but we'll see. I'm also just looking at it as if I can flip it for, I'd be happy with like $1,000 or two on the trade. Okay, now let's come back to our daily profit play. Let me see here on SPX. I mean, you could just have it. I posted it for everybody. So the VIX trades posted right here for everyone. There it is. It's in the chat for you. So this broken wing for Friday is a 6,700. We're only 30 points away from that. It's certainly in the way. I'm hoping that we can stay below 6,700. That's a pin price. That's a butterfly. We have non-farm, which we might not even have non-farm data. This is going to be really interesting this week. And I've got some rolls out from the waterfall income. But anyway, let's look at VIX this morning. October 1st, we are moving back up. So opening here, 60. I mean, if I sell like 67, I'm going to try to sell this like 10. Maybe we can get filled here at like the 5x10. Just trying to sell the 50% ATR. Let's see what it offers. So can I do like a 67 or 67.05? 6,700. I'm going to see if we get filled. I'm going to go 6,705 for a buck. 6,705 by 10 bear call spread for $1. Let that marinate. And let me put in, so a standard, let's see. It's got the 5 by 10, 15 by 20. I'll put those two in for $1. Okay. And then on the put side, let's see where this is adjusting in real time. So here's my real time gamma levels. It gets sticky around 60. I mean, it gets sticky back around the highs yesterday. We have a lot of call resistance going into that 67.10 zone. On the put side, like a 66. I mean, 40 is not that far away. That's 100% ATR. We gapped lower. Open at 64. I'm going to set these a little bit lower. So there's going to be some pending orders this morning for me on daily profit play. I'm going to put in the 66, 20, and 15. So 66, 20, and 15 for $1. And 10 and 5 for $1. All right. So pending orders are coming. I don't have a single trade filled yet on daily profit play. They're all pending orders. It's going to be 2 bear call spreads, 2 bull put spreads based on my daily profit play indicator. That's where I'm at. Okay. So pending, I'm putting this Telegram for members right now, pending orders. I'm setting up 2 bear call spreads and 2 bull put spreads using the DPP indicator and ATR levels. So 10-1 expiration, 67.05 call, 67.10 call, $1 credit, pending. 67.15. Okay, on the put side, 20 and 15. And last one here. That is the 10 and 5. Okay, so it's 4 trades. I just posted it in Telegram. Is this a specific strategy on the VIX? Gina, so what it is, I'm officially making that trade. Deanna, I'm going to post that for you in our Slack channel. Send that out for my master or my crash insurance, please. In case they're not here for my daily profit room. Let's go crash insurance, new trade. So what I'd like to see on that VIX is we took the trade for a 285 debit. I wouldn't mind setting like a $10 credit. That would, I mean, that's a $7 and change profit. That's over 200%. That's pretty good. But in case something gets really wild and crazy, it's like, I don't want to just cap the upside. I'm hoping we have a chance to at least try to close it down for a winner. Okay, Bill says not sure how to execute 3 single legs. Well, remember, Bill, it's not 3 single legs. It actually makes a combo trade. So the trade on the VIX is, I'll go into the option chain here. So the trade on the VIX I mean, stocks lower. It's like, are they lower? They gap lower and we're still fighting back. I mean, the E-mini futures are only down 0.17 right now. I mean, I'm just hoping that we get filled on a bear call spread. And by the way, we are still looking at positive gamma above 6660. This is, I'm telling you, this is the important level for today. If we stay above 6660, this market is probably not going to budge. So I'm trying to sell, into the call walls and trying to sell above the expected move. But I mean, look at the VIX. We went from a 17.3 VIX overnight down to a 16.4. I mean, I just hope we get filled. So my 67.05 and 10 is trading for 64 cents. So that creeps up to $1. I think that's a really good looking trade, actually. Let's see. I mean, is today like big fat news? Is it going to be just this typical daily profit play? What I was going to show you on the VIX is that November trade. I mean, all you have to do is build the ticket. So if you sell the 17 put, buy the 17 put, that is a synthetic long. Okay. And then you add in the 16. So let me just show you how, if you build it out. I don't know if they have option strat for VIX symbol. I think they do, but I'll build out where my synthetic longs. Yep. So I got the VIX here and the November 19th. So I can do it at 17 and 17. So this is what a synthetic looks like. And I do this on stocks when I'm like, I'll own the stock here, but also I want to be long with unlimited profit potential. So a synthetic is a good trade. It also costs way less than just buying the stock buying the underlying with 100 shares. So synthetics are pretty good. But what I added to this is a buy put at 16. Okay. So now rather than having unlimited risk to zero, I cap the risk. So my max risk is about $380. But my unlimited profit potential is, let's say that, and this is what's interesting is look at where this thing goes. If I zoom out here, okay, I just want us to get somewhat excited. If we have a big jump in volatility, if the VIX spikes up into the mid 20s, we're probably going to make 100% on the trade. If we spike up into the 30s, we're making 200 plus percent. I mean, and I wouldn't bank on the VIX jumping up into like 60 and 70. I would bank on maybe a mid 20s, maybe into the 30s. So I think we turn, a 285 debit into maybe let's hope for like an $8 to $10 credit. But that's pretty good. Did I buy? So it is a VIX call. I bought the VIX call and I sold the VIX put. That's why it's a synthetic long. Because the VIX call is what's running for unlimited profit. But because I sold that put, that way my break even is pretty much at the money. Because usually if you buy a call option, you've got to pay that debit. Your break even is going to be the cost of the debit, higher than price. But because I do it at the same strikes, now it's a synthetic, which means it's just like buying the stock outright. So I buy the 17 call and I sell the 17 put. And then I bought the 16 put to cap my risk. So those are the three legs that I put for that trade. The next debt vote, I don't know, but I feel like they punted that out a lot longer. I don't think the debt ceiling is coming up anytime soon. And if anything, the debt ceiling never matters. It never matters. It's all like build up and anticipation and uncertainty. They always pass it. The U.S. government is going to be made to look like they'll look so foolish if they ever default. The whole world will feel it. I don't think they're going to let that happen. So, but Congress likes to pat themselves on the back and we stayed until midnight. We worked overnight over the weekend so we could pass the debt ceiling. They know they have to pass it. It's just all the drama that surrounds it. Yeah, we'll see. I mean, I don't know why we even have the conversation. Like, there's no such thing as a balanced budget, not in the U.S. It hasn't been that way for, I mean, Clinton might have been the last president with a balanced budget. Obama was the one that tried for a balanced budget. That didn't work. Once we had 2008, 2009, we didn't have a balanced budget. And now it's just like, what's the point? Just raise the debt ceiling. I mean, every like 90 days, we're getting close to like $1 trillion added to the debts. It's kind of crazy. So anyway, speculation. All right, where are we at? I mean, I don't want to settle for 50 cents. So the 60s, let me see what a 6,700 looks like. So go back to SPX. So 6,700. So I might take a pretty aggressive daily profit play here. I could go 66.95 by 67 and then try to stay at the 30 and 25. I mean, this isn't a bad trade. I'm going to take a daily profit play here. I'm going to get in for $1.50, $1.45. See if I can get this trade filled. This will be a standard daily profit play with lower risk. Okay, so I'm in a trade here. This is official trade. New trade, SPX, 10-1 expiration. Okay, I got filled for $1.45 credit. So standard DPP, $1.45. And that gives me a 355 max risk. Looking for, I'd say the debit on this one, if I get a 0.7, I mean, a dollar debit's not bad. So $1 to $1.10 profit target's not bad. See here. Is that Mikey? I might have missed it, but can you show the P&L graph for the VIX trade? Yep, that was on option strat right here. It's a synthetic long, but I capped the risk. Otherwise, this red line would go all the way down here, and it would go to zero. So I'm capping the risk at about $380, but I have unlimited profit potential if the VIX goes up. So if the VIX is positive, the VIX starts to go up above 20. This is a positive VIX. Okay, the VIX is trading around 16.5 right now. It's like I'm looking for the VIX to go up into the 20s. If it goes in the 20s, we get paid pretty well. That's the point of the trade. Okay, I posted it in the chat. So if you're coming in late, I'll post it again. There's a trade that I took on the VIX. Now the market's selling off. All right. Hopefully it's just a bunch of noise today. But this looming shutdown, we could probably see some flows, as I mentioned, in futures, right? A lot of noise right now at futures. So market sells off during futures, rips back up. A lot of noise happening right now. Keep an eye on this for today. So this is that's a standard. It's up a quick $17 right now. $20. I don't like how price is falling right now. I might just close out that trade really quickly. I know that's really fast. Let me see if I can grab a quick profit on this thing. So go $1.25. All right, I just closed out the daily profit for 20-cent winner. So I'm already out. That's super fast. I mean, I got in at 46. It's now 9:50, 4 minutes. I'm out for $20. I'm just going to close it because price. That's a very aggressive 5-minute candle. Okay, that's a really aggressive 5-minute candle. Obviously, if price is going to stall and we go aggressive 5 minute candle and it just sits here. But I'm telling you, be careful of this. This 6660 is a positive or negative gamma pivot. If we are below this, things could open up a lot faster than what we want to the downside. You can see here that the put sentiment is pretty aggressive, 51 versus 16. That should give the Bears the upper hand unless they can defend the 6660 zone. So I think the smart thing right now is probably just to chillax on some of these trades. So I'm going to keep in the bear call spreads. I mean, we're at 6660. I've got a 20 and 10. That'd be a nasty, nasty day if we fell. I mean, 20 and 10, it's well below the 100%. I think we'll be okay. All right. So very quickly, DP update. Super quick trade. Entry for $1.45, close for $1.25. Small winner. Let me see what's trading for right now. Price could have settled down a little bit better. It's still trading for a buck 25, buck 30. I'm just saying break even or better. I don't want to let it be a loss. Just in case there's more follow through to the downside. So I think what I'm going to continue to watch for the remainder of the morning is if we are going to push below 6660, this market opens up to the downside. I like our bear call spread levels. I'll let them still sit and pend. I even like our bull put spreads all the way down because I'm using the daily profit play indicator, right? I mean, our levels, this is a 20, and that's where I'm starting my. So the 20 by 15 is the bull put spread. The 10 by 5 is the bull put spread. And then on the call side, I've got the 67.05 and 67.15. Yeah, I'm just going to keep those trades in. So right now, the daily profit play is trading for about $1.30, $1.25. You should be able to get out with a small profit if you want. If you want to go after the standard, 20, 25%, 25, 30%, that debit between 110 and $1 and just let it sit. Okay, so we'll keep an eye on that one. So the pending orders for daily profit play are still going. 2 bear call spreads, 2 bull put spreads, all pending. The daily profit play was already in and out. In for $1.45, out at $1.25. That was quick, very quick actually. But now we just need a little bit more time. Why couldn't you just buy the VIX call? Well, if you just bought the VIX call, you're paying a lot more money for it. Watch. Here's the VIX. If I just bought the call, I want you to see the net debit. If I just buy the VIX call, let me get rid of this one and let me get rid of this one. Okay. If I just buy the call, there we go. And here's why. If I just buy the call, my break even point, if I buy the call, my break even is going to be the debit higher. So I need price to go that much higher. Okay, at least if I'm creating that synthetic, it kind of starts at the money. That's the only reason I like synthetics. But like I said, I'm capping that risk. Okay, is anyone still hanging on to daily profit play? Small profit. If you want to keep it going, it's down to $1.20, $1.15. This is good. I'm just saying my warning on the day is if we get below, this is negative gamma, this is positive gamma. If we get below 6660, there's room for price to fall. Now my bull put spread is all the way down here, and I'm hoping that's enough to stay out of the way. Because that would be, previous day at 90, we'd go all the way down. Do we hit the 100, 150% ATR? Maybe, but I'm hoping there's enough to offer a bounce. Okay. But it seems to be just defending that 6660 zone right now. Holy crap, dude. That is a big jump in price. Like, this has to be Bitcoin related. Either gold, silver, Bitcoin is making a surge because that's another big fresh high on the year. Let me see where my P&L is coming from. Big jump on Pfizer. There you go. That helps. And MicroStrategy's up quite a bit today. That's good. Bitcoin, yeah, I had a feeling it'd be gold, silver, Bitcoin would be getting a jump. Okay. And I've got some profit levels on Baidu. Baidu chart alarm, I'm going to close this thing out at like 150 to 155. Profit target's already set. Okay, still in the Condor. That's fine. Condor is still looking good. I mean, it's definitely centered. Pretty volatile, 27 minutes into the trading day so far, but gap lower, up, down. It's right around center price. So it's still pretty contained. But all good. Okay, let's have a look at some other stuff. Let's go gold and silver. Gold, we just printed another overbought condition with divergence. I am expecting some pullbacks on gold. It's not going to be fun when it happens, but I'm ready to scoop up some dips. Um, I think it'd be pretty embarrassing for gold to give back a lot of the gains for the year. I think that gold, even if we have a pullback, it's probably aggressive buy and dip, or we just keep melting up into the end of the year and this thing corrects, heavier and harder in 2026. But my pullback is, it's about a 17% correction expected on gold. So just be ready for it when it happens. And more importantly is when we get a correction in gold, is I'm looking to add more exposure. I want to get some dips and buy those dips. Silver, I got the chart alarm set. If we get to these spot prices at 49 to 50 bucks, I'm going to start taking some profit on silver. I've been in this thing since COVID. So just a great structural trade. I mean, you couldn't ask for a better textbook trade. We had the 618 pullback here, COVID low, COVID high, or post-COVID swing, 618 pullback. And I just done the measurements all the way back up to all-time highs. So, symmetry alone, pretty good. Low to high, low to high. And let me see. I should have one more. So way up here. I'm looking at all-time highs as a nice profit target. Once we finally broke these highs around 30 bucks, it's been choppy, but it was setting the sights on all-time highs. So I just think silver is a pretty good position. It should be up close to six figures. I want to make sure I'm protecting it. I'll keep the allocation to the percentage that I want, but I've got a good chunk of profit I want to protect. Gina, the Condor. So I'm looking to establish on the Condor. I am selling, buying, selling, buying. So I'm creating two credit spreads on my Condor. Yep. All right. How's it looking? Who's still in it? Anybody still hanging on to it? You got some profits. 115 debit, 110 debit. It could just be just another simple Wednesday. Take your profit. Out at 115, Susan, good. Okay. Yeah, if it just stays sticky today around 6660, then daily profit play is the bee's knees. You did wider for less. Got it. Okay, $1.05 looking for 55. John, 15 wide at 295. Okay, how's it looking so far, John? I mean, this price action is good. You want to see price kind of bounce around between this 66.60 and 66.75 zone if it doesn't really breach highs or lows. That's nice and centered. Got it. Waiting to hit two. Going after a 32 percenter, huh? At 230 now. Okay. You know, there's all sorts of ways to take the trade, right? You go 15 wide, 10 wide, 20 wide. I'm just telling you, whatever you do widthwise, the best mechanics are going after the 20, 25, 30%. 20, 25, 30% across the board. It doesn't matter how wide, doesn't matter where you start this trade. 20, 25, 30% are going to give you that high win percentage. So, in other words, I'm just saying, don't be greedy. Anytime you're seeing 20, 25, 30%, it's okay to take some profit. Okay. That's the mid price, about $1.15, $1.20, $1.10, $1.15. Not bad. Let me bring up. I'm going to bring up my pinch point scanner for this morning. Okay. So pinch point scanner. I'm going to have a masterclass on pinch point this afternoon. It's going to be 1 p.m. Eastern time. We're going to do a live trading session. So I wanted just to carve out extra time. I priced out like 15 trades last week and didn't take a single one because the options chain wasn't as precise as I wanted. So I want to spend 60 plus minutes or 90 plus minutes with pinch point scanner members today, trying to find some trades. We've got 47 in the go zone, which is a nice chunk. We'll obviously take a look at these at a glance, but this is a pretty healthy list of stocks that are ready to make a move. So they're not all going to be trades, but certainly if I can get 3, 4, 5 of them, I'm pretty happy with that. So this should be pretty solid. Okay. That's my watch this Wednesday. I'll run the masterclass. In fact, I mean, for pinch point members, I don't mind doing this like every Wednesday. I think this is, I mean, it's something that's like I routinely check it. And then I spend the time pricing it out. If I like a trade, I post in the alerts. But I wouldn't mind trying to do this for pinch point members every week where we have just an actual trading session. We can jump in here and try to find some trades together. So if anybody wants pinch point scanner, you want to start doing a routine trading session with me on Wednesday, I think that's a good way to do it. So to kind of go the theme of watch list Wednesday, we can have an afternoon session and price out some trades. Okay. Daily profit play now showing about $1.10. Anything less than that is good. $1.10, $5, debit. Those are all good. Price is doing little to nothing today. Which again it's interesting. I don't know if it's just we're just so convinced that this market's like positive gamma. I just think it's a matter of time. I mean, it is perplexing that this market hasn't had anything more than like a 1 to 2% pullback. Outside of this pullback here, July to August, it has been like less than 2%, less than 2%, less than 2% the entire time. I think this one might have been over 2%, but that was a high to low about 2.13. Oops. That one's just over 2%. Less, I mean, the FOMC was like 1.1%. That was less than 2%. So yeah, other than that, this is a 3.3% correction. Everything else has been 2, less than 2, less than 2. $10, $15 on the daily profit play. Larry, didn't you ask that question earlier? Or somebody else asked that question? Yeah, I said because if I just buy a call, my debit is my break even's further above. If I do synthetic, it's at the point of my synthetic. So if I buy a 17 call, sell a 17 put, my break even is at that point. That's where I get the benefit of the long. The synthetic is it's like having long the stock. And so even if the VIX goes from 17 to 18, I get paid on the trade. If I bought a call, I've got to cover that premium. That's why I didn't just buy a call. I received that waterfall trade for this week. This morning is still good. Should be. I can check it. Let me see what the trade is that we put in for waterfall income. Waterfall, the trade that's been open for 2 days, that would have been this week. So this trade, let me put this trade in. So this was filled at 60 cents. Yeah, it's still, I mean, it's valid. So yeah, 60 cents, 65 cents, still valid. You can take the same trade. I still like the mechanics. The deltas are about the same. So yeah, that's a strategy 2 for waterfall income. That trade's still good. FOMO. Did you watch the session? And if you watch the recording from Waterfall, I mean, I break down, all the trades and why we do it. Plus, we've had a lot of master classes. Look, the last probably month or two, I have had maybe close to 10 daily profit play master classes. I've had close to 10 waterfall income master classes. I've had close to 5 or 6 double ups. This is why I'm doing a master class or live trading session on pinch point. I'm doing a master class this week on Project Options Edge on Friday. So I do want to incorporate more masterclass live session education through the week. If anybody's interested, um, Project Options Edge, I'm throwing it out there. This service is not just offered online. This is something you usually have to call the support team for. This is, I'll just call this my kitchen sink trading service. I can do whatever I want. I can trade, all the strategies that I know how to trade. I will trade in Project Options Edge. It's a little bit more cash heavy or cash intensive. We can own some shares. We can do some campaign trades. We can do poor man cover calls. We can do synthetics. We can do ratio spreads. All these fancy names and strategies you may not have traded. But I think I've lost one trade this year in Project Options Edge. The reason I'm sitting at year-to-date highs routinely is because of Project Options Edge. So if you're interested in a masterclass where I'm just going to open the curtains, open the doors, let's talk a variety of strategies that we've taken, plus review our open positions, that's going to be a masterclass on Friday. Okay, Bodo says out on the wider condor, good. So today, what percentage of this VIX trade is my total? I mean, not much. So Jay's asking, what percentage of the VIX? I mean, it's just a single trade. I'm keeping the risk less than 381 because remember, hedging is not about taking big risk. Hedging is about getting asymmetry. If I get paid on a hedge, that $381 risk could offer me $1,000 to $2,000 of pretty realistic profit. Okay. So and here's what helps me. If I have that trade on all of these accounts, I think there's 16 or 17 of these accounts. If I have let's say I make $1,000 on the trade, and I do this in all my accounts, it's $17,000 that just helps me buffer any type of pullback and drawdown. Okay. Yeah, I get it, Ken. I don't know. And honestly, a lot of those trades, when they closed out, we didn't really close them out early. So a lot of them closed near expiration for strategy 2. That's your question. So strategy 2, a lot of times I'm holding them near to expiration. Yesterday for waterfall income, I'll do an update on that one right here. Waterfall income yesterday, we had a big fat profit trap on one of the trades. So I'm going to have to add another line to it, but I'll show you. So waterfall income here for the 9:30 expiration, the 25 by 30. Okay. The 25 by 30, I'm going to add in a line here. This would be the 94 bull call. So exit date will be 9:30. We initially started the trade. Actually, the trade started 6:30. So 6:30. Oh, geez. How many days is that? I guess it'd be 90 days, give or take. Equals, there we go, 92 days. Now that's a long hold, but it also hit full profit. So the SPX 9:30 expiration, 66.25 call, sell the 66.30 call. That trade was only a 93-cent debit and exited for $5 profit. So that profit is 4.07, and that risk was only 93 cents. That return is pretty solid. Okay. So that was a profit trap. That's why we've been doing strategy 2, because every now and then we get a big fat profit trap that pays us a crap ton of money. And I mean, that's what helped me survive. A lot of big profit chunks were given to me in 2022. And I mean, COVID was an easy survival. You had to buy the dips. But 2022 was a tough 10-month bear market. And strategy 2 helped me make a lot of money. So we're still holding this trade. There's still risk in this trade, but I've rolled this thing. We're up to 290 credit on the remaining 66, 40, and 60. I also did a roll yesterday for up to $3 and change. So I mean, I've reduced the risk quite a bit on the credit spread, which is good. Okay. But a lot of these strategy 2s I'm holding to expiration, or I'm holding to like 85 or 90% credits. So all these trades here, the exit date would be probably close to expiration. Or if we close it, if I close this thing down for like a 5-cent debit, then I'll put in an exit date. But and I've said this a lot in the master classes, strategy 2 is not a 10-day hold. Okay. Strategy 2 is going to be typically out 60, 80, 90 days because we have the profit trap, because we're way out of the money. I hold those longer. Strategy 1, I just want to get a pullback so I can actually take a strategy 1. And hopefully that's coming sooner than later. Okay. And that's correct, Buck. Yep, exactly right. So we're still holding that trade, but we had a nice fat profit trap yesterday. Correct. Okay. Let's see here. Let's see how the credit spreads are trading. So the 68.25 not filling, call spread not filling, call spread not filling, put spread not filling, put spread. So my pending order credit spreads are not filled yet. Those are based on the daily profit play ATR levels, and the VIX box not filled yet. Our Iron Condor is now trading for $1.05. So there's your 20, 25, 30% take profit. If you pull out, $40, you're up 27.5% if you close it at $1.05 debit. Good trade. Okay. Good trade. All right. So I'll get our daily profit play tracker updated. I also want to get in my levels really quick. I'll add this right now. So let's go in the ATR tracker. Today is 10-1. 50% ATR up is 67.10. 100% ATR up 67.33. 150% ATR up 67.55. 66.65. Okay, just getting these put into so there's an extra tab that I put into our daily profit play tracker. 66.43. and 66.20. Gap lower, opened up at 50% ATR down level. So the opening price was around 66.59. I'll add more notes to close out the day, plus I'll take a screenshot. So what I've been doing is this. Pull this over here. We have our live trades, and then we have our tracker. So I'm taking screenshots at the end of the day just to get a reference of how many times are we seeing prices exceeding either the ATRs up or down and where they're likely going to close. Most of the time, we're going to see prices contained within probably the 250% ATRs. Rarely will we see prices beyond the 100% ATRs, which is why I'm placing the trades that I am today that are pending orders. Bear call spreads, bull put spreads. I'm trying to get them outside of the 100% ATRs, or at least to at least the put side. Trying to go out of the way. Okay, so I'll just keep tracking that day to day. So for the day, interesting how that 67.50 gamma level disappeared, huh? And for the day, it's like we're sticky between 67, 66.50. We're still in positive gamma environment. So far, this has been a pretty solid daily profit play, which is why Mondays and Wednesdays have given us, 90+% winners. Have you changed anything on the waterfall place 925? I don't think so. 925 would have been last week. Was it placed or executed on the 25th? Yeah, there's nothing. That trades, I mean, the SPX would have to drop to 5,600 for that trade to be in trouble. I think we're okay. Yeah, nothing changed. Nothing changed. Okay. So hopefully for the remainder of the sesh, I'll talk through some daily profit play. We did have a bunch of great notes this week in daily profit play. I'm trying to think. I had some screenshots here. I posted this in the chat yesterday. Talked about market maker moves. So standard daily profit play. Also the notes. This is a lot of notes from class yesterday, but I reviewed. If I can zoom in and show you this, the daily profit play indicator on TradingView and Thinkorswim. Also the core strategy, and then the bonus strategies, either going the directional, like yesterday was a reverse iron condor, so we benefited from price going up late in the day, or just the simple credit spreads or broke wing butterfly. So we spent a lot of time reviewing that information in class this week. So we had daily profit play masterclass Monday and Tuesday, notes, screenshots, recordings for all my daily profit play members. Okay. And then today, I'm going to be jumping into a live trading session on my pinch point at 1 p.m. Eastern time. And we're going to find some trades. And then on Friday, like I said, Friday is going to be a Project Options Edge masterclass. And we're going to review a variety of strategies and review our open positions, which we have a few. We have quite a few open positions, which is good. This is my most discretionary service where I can trade whatever strategy I think is going to be best for the income. Cool. All right. Let's see. So here's what I'll say. I'm gonna break a rule here. I don't want to pitch anything today. I just want to talk for the next 40 minutes. Let's do like an open Q&A. You good with that? Ask me some questions. We got a nice big room here. I don't see everyone jump out. We've got trades that are still running. I will see if we get anything filled here in the next 40 minutes. Maybe we get a bear call spread or bull put spread filled. I want to kind of open this up for a Q&A. I do have a role that I need to take care of right now. We can talk about rolling some trades. I put this in Telegram yesterday. I ended up doing some rolls on some of my positions, new class or new crash insurance right here. So I did some rolls yesterday. NVIDIA, I improved my cost basis by $3.70. I mean, overall yesterday, I saved myself about $4,516 in rolling some calls. So it's either going to help me, one, generate additional income, or two, lower my cost basis. But these are all good. I'm going to let the shares of Walmart go this week. I have some shares of Walmart with a covered call at 100. It expires on 10/3. I'm going to let it go because Walmart's trading like 40 times earnings. I'm going to sell some puts. I think we've got some ratio spreads for Project Options Edge that I can put in, but stay tuned. So I'm going to try to let JD run longer. I'm going to try to let Qs run longer. I obviously want to see if Tesla can get back to all-time highs. MicroStrategy had a big jump today. We've got a nice little pop on Bitcoin. I'm not going to be terribly surprised to see Bitcoin try to make some all-time highs by the end of the year. So that could hopefully help some MicroStrategy positions. It's kind of like the 2 to 3 times leverage Bitcoin at this time. It's just trading like a leverage proxy to Bitcoin. And then NVIDIA lowered the cost by 370. Okay, Bonus is going to ask about rolling. Yeah, we can talk rolling. I do want to I've got one trade in here that I want to roll. I don't think it got filled yesterday, but let me check. So all symbols. So did it get filled? Okay, so I can go out to October, bump it up. Let me get this thing for maybe a 5-10 roll. Or 505. See, 509 maybe. Right, I'm below the mid price. Got filled for 5. Okay. So let me show you this. This is let's see here. Rolled to 1231 and up to 626 for 509. All right. So now I'm going to grab my tracker. This is some old school stuff, but this is the best way for me to manually track. Let me just get the account number. This is 7854. So SPY. All right. So initially I have a SPY break even at 613.61. And what I just did is I rolled out to 1231 expiration and up to 626 for 509 credit. So that allows me to lower my cost basis now. 613.61 minus 5.09 brings me down to 608.52. So new break even at 608.52. And if I get it called away at 626, I'm making 1748 on the shares. So I just went from about a $900 winner. Well, I guess a little bit more than that. Yeah, actually, it's about right. So I was likely going to make about $900, and now I'm potentially making 1748. All I need the S&P to do is stay where it is. But what I'm going to continue to do is keep rolling this. Keep rolling this. Because right now I'm in the money. I'm rolling a call to 626. The SPY's trading for like 660, right? So am I sacrificing some upside? Yes. But if I can keep adding covered calls, I still get paid to add more time to the trade, and I can generate an extra maybe 300 to 500 bucks a month on this trade. So as the owner of the S&P, as I own shares of the SPY, I can keep rolling calls. So let's have a little example. Is there any stock individually that you want to own? Okay, because there's a couple ways we can tackle, rolling or doing covered calls. Usually when I roll things, my rule of thumb is I roll for credit. I don't like to roll for debits. I know you could roll it up for a debit. It's a lesser debit. It gives you profit potential. That's fine. I still like to roll things out for credits because I want to lower my cost basis. My goal is to roll and lower my cost basis. So I'll add some notes here. IBM, okay, sure. I realize on Tasty you should never let SPX spread go to expiration and get cash settled each leg a separate five. Um, I don't mind calling their trade desk and asking. I think that seems a little steep because, like, what would be the point of? I mean, they have an entry in, no exit commission, but why would they charge to exercise? I'll call the trade desk and ask. That seems a little steep. I can go into my history and see what the fees look like too, because I have a lot of these, especially on my churning accounts. Like I'm really active on this one. Let me see something. I'll go to history. I'll go to SPX. Am I dealing with fees? I mean, I'm only showing 77 cents. I'm not showing $5 exercises. Go to the last 7 days. Cash settlement. Okay. I mean, otherwise it's 77 cents. So in the last week, I mean, I've had this happen once. That was two contracts. These are all one contracts. Rolls. So I see one in here. And I'm not exactly sure what trade it would have been, but there's a cash settlement at five and change. Was that yesterday? No, 26th. I mean, I also made 865 bucks, so I guess $5. So I sacrifice a coffee for the day to get some profit. It's not like it's a fee you can walk away with. I can't call them and be like, take away that fee. It's like it's going to be something they're going to be like, yeah, we have to charge it. Okay. I mean, I don't have a lot of leverage in this situation. I can ask why, but what I need to do is just monitor. I mean, there's no free lunch, man. Like trading, there's going to be commissions. But here's how I can do the math. Right now, I have $621,000 in profit for the year out of a showing P&L year to date of 638. So I will do the math and show you. Okay, so I've got 621 and 638, 17K. That's less than 3% of my profits or fees. Show me a broker that has the type of fee structure. I'm coming from a currency world that was taking about 10 to 15% of my profits. As far as like my net positions based on the rolls and the swaps and the commissions and the, like freaking spreads. I mean, it would be like close to 10, 15%. So this is the lowest fee structure that I've ever had in 20 plus years of trading. I'm just not complaining, so 70 cents or a dollar or even the occasional $5, it doesn't really matter that much. Because I don't think it's $5 per leg. I don't. Else they'd show it, right? Why is it only showing cash settlement 5 and 5? I mean, was it a 2 leg trade? Maybe. But I can ask them. I'm happy to call the trade desk and see, like, hey man, this cash settled SPX $5 fee. Tell me about it, and give me an explanation. Because I'll ask them, okay, if I have a trade that's running to let it go to expiration and it's cash settled, am I getting charged every day for a bear call spread to close out it? Because what would bother me is if I can't close the trade for a 0.05 debit, if I think it's a guaranteed winner, why wouldn't I let it just settle at 0 cents? I mean, realistically, if I wanted to close it out for the best trade possible, an SPX trade with a credit, if you close it out at 0.05 cents, that's the best fill you're going to get. If you're going to close it yourself, 0.05 is the best fill you're going to get. So to have it close at 0 and they ding me for $5, it's essentially the same. Does that make sense? Like that's the only way I'm trying to justify, like, why would they charge it? Well, because you close it out at a 0.05, that's the best fill you can get. Otherwise, they guess they tack on that $5, which is like a 5 cent close anyway. So I don't mind it. I just think like but I'm happy to call the trade desk and just ask them. but I feel like that's kind of the math that I would do. Is like the best fill I can get is 0.05. The best fill on the SPY is 0.01. Otherwise, it settles. But I'd much rather have a settlement on XSP, SPX because it's cash settled. There's no assignment risk. So I don't know. I have a feeling that's probably why they do that, is because your lowest fill on a credit side is going to be 0.05. It doesn't work like that, Kent. You have to just show that you're an active trader. I mean, I get some pretty good fees, but I'm also taking. I mean, I can show you. I've got $17,000 in fees. Okay, $17,000 in fees at on average like 77 cent. But in a lot of this is because I trade SPX, or it's roughly 60 cent per contract. So right now that's showing that I've taken about 10,000 trades for the year. And that's at 70 cents. Now, if I did it at 60 cents, it'd be a little bit more. But yeah, I mean, I'm typically taking like 20,000 trades a year, usually. So I think if you don't have to be in that type of like level. I would say if you're going to take like 2,000 trades a year, the brokers are pretty open to improving your fees. So they really base it on your habits and your trading activity. So if you're showing, several hundred trades in a couple of months, they will probably listen and budge your commission. Don't tell them, hey, I follow Chris Pulver. He has low fees. They don't care. I mean, I do refer a lot of business to Tasty because I think they're a fantastic broker. They've treated me very, very well for the years I've been with them. But the reality is you have to show them that if you're an active trader, they'll take you down from $1 to 80 cents, 80 cents to 70, 70 to 60. They'll hook you up, but you got to kind of prove that over a 3 to 6 month window, 12-month window, that you're active enough in their platform that they will justify it. Okay. All right. I saw the question earlier on IBM. So Rich says you're rolling on those particular trades. Yes, Rich, like that was an in the money call. So I'm rolling in the money calls on NVIDIA and Tesla and MicroStrategy and the SPY and the Qs. Those are all in the money. Now, it'd be nice to have it be, at the money or out of the money. One thing I'm going to look at I mean, now that I do this stuff every single day, I mean, zero DT has been a part of my life for the last 3 years. One thing I'd be interested in doing is, and I don't know how much this is going to fill, but I'm just going to spitball this. Okay. Let's say that I buy 100 shares of the SPY. Okay. Now, if you want cheap protection, consider the collar trade. That is, you buy shares. So I have, let's say, 100 shares, and then I buy a put and I sell a call. And I like the collar trade for a small credit. So that way it's the benefits would be I lower my net cost. I have downside protection with the long put, and I have price appreciation at fresh highs for my sell call. So I can still lose the position, right? I can still lose on the sell call. I get the shares called away, but at least I would turn it into a profit. So this is one really simple way. If I just own shares of something, and I did a lot of these trades this year. And in fact, a lot of my trades right now have flipped from I started out with I bought the shares, I did a collar trade. The put side protection didn't matter because a lot of the stuff I started buying and owning was back in April and May. And we just been going up ever since. So the sell call ended up going in the money. And rather than just letting the shares get called away, I've just been rolling calls like month after month. Okay. And so I don't really need the put side protection right now because my cost basis is so low that price would have to drop a ton for me to have this thing be threatened. But the reality is, that's one really cheap way to protect the downside, also have price appreciate for you, also generate some credit, and it's a small income. Okay. So I don't mind doing this. I'll put just, I'll put like a collar trade here. Everybody understand that? So if you're ever in doubt about, owning shares of something and not really sure what to do to protect the downside, this is one of my favorite ways to do it. Okay. I don't like to just buy shares and then buy a put. If you own shares of something and buy a put, that's a debit, right? That's a buy put. That's a debit that increases your cost basis. So I like to do a collar trade, which yes, I sacrifice the upside. Okay. But I can basically finance the long put. So if things go down, I can go down with it. And I can lower my cost basis. Jazz hit 135. Did we close the thing for profit already? We did. Pinch point scanner. Jazz hitting. Yep. So we finally got the pinch point move that we wanted. We closed this thing for profit. This was down like $200 or $300. We closed it out for like, I think 50 or $100. I don't think I'm in this trade anymore. Let me double check. Let's go Jazz. I'm pretty sure this trade closed. Correct. There's no Jazz in here, but let's go last 60 days. Or maybe I can just look for it in the history. History. There it is. So a small winner. And this was down like $300 and it turned into a winner. We needed price on the original trade for pinch point. Pinch point. It would actually, it wouldn't matter. We were out of the trade with a small winner, and we needed price to get. That was, well, we didn't time it well enough. It would have been close because we had a 125 by 135, and it's hitting the 135 right now. We had our expiration originally on Jazz from June to September, so it was a September 19th expiration. So let me see where this would have been on the 19th. So the 19th. Yeah, I mean, it would have been break even. Now's where you get that profit. So had we gone out a little bit further, like the October expiration, this would be trading for close to, $9 or $10 credit, which would have been pretty sweet. But I'm just happy we turned it in. It was a losing trade for pretty much a month or two, and we turned it into like a $30 to $40 winner, which, like I said, I'm totally happy that it was what was that. And then pinch point did exactly what I wanted, which is just give us the volatility. Okay. So let's go back to this little lesson. So if you're ever wondering, okay, Chris, I own shares. I want to protect the downside, but I hate paying for a long put because that just makes it increase my cost basis, right? Does everybody follow me? Type in a clear in the chat if that makes sense. So if I buy 100 shares of the SPY and then I buy a put, let's say I buy a put out, 60 days and it costs me $5 debit. Well, that increases my cost basis on the SPY. But yes, I have downside protection if I need it. But what has the market done since the bottom of April this year? Not go down. So all you're doing is wasting money. So at least with a collar trade, I can have the downside protection in case I need it, but also put my price levels up a little bit higher. So the way that I like to do a collar trade is I might go on the SPY, for example, I might go like $5 or $10 higher for my call and $5 or $10 lower for my put. So I might do like a, out of the money sell call, slightly out of the money buy put. That's my collar, and I get some price appreciation. I still pull in a net credit. I might lower my cost basis by $1, but I get like $10 more upside. If it gets called away, cool. Otherwise, if price is clearly ripping higher, I can just now start selling in the money cover calls. So this is, I would say, not my favorite. Not my favorite. I don't like to do that. Okay. The other one is, covered calls. And you can go, at the money. You can go in the money. You can go out of the money. Let's get some notes here. So covered calls, they're a sell call on an asset you own, right? So 100 shares equals one sell call contract. Okay, I'll put a note here, do the math. If I buy SPY shares at 660 and sell, let's say a 665 sell call, I guess sell a 665 call for, $5 credit, my break even is 655 on the owned shares. That makes sense? So I buy the shares at 660. I collect $5 credit to sell a call that lowers my cost basis down to 655. I still get the shares called away at 665, which gives me now $1,000 of profit versus initially 500 bucks. So it lowers my cost basis. Right? So simple math in that. At the monies. So here's my kind of rule of thumb on calls in general, covered calls in general, or rolling calls. At the money is when you're telling yourself, I'm happy to let the shares be called away, or I want reasonable premium for a covered call, and I can continue to roll out in price. I should say out in time and up in price. Okay, so my rule of thumb for rolling calls or trades in general, you have two things. You're looking to roll out in time, which is probably the most important thing, and possibly up or down in strikes to improve or extend the trade. Does that make sense? So when I'm looking to roll, what this means is if I'm rolling a covered call, for example, it's usually rolling out in time. And if I roll it out in time and I keep the same strike, I can generally keep a decent credit going. So I want to go out another 30 days. The SPY might give me, like I showed you, I went out from an October expiration out to December. So I'm going out November, December, so about 60 days, and the broker is going to give me $5.10. So that's $510 of bonus profit by just getting the trade extended for another 60 days. And as I come into Q1 next year, I can do the same thing. I can keep rolling out another 30 days or 60 days, hopefully get another $3, $4, $5 of credit. What that will do each time is if I'm getting credits, it lowers my cost basis each and every duration. Okay. Also, what I ideally like to do when I'm rolling calls is I like to roll out in time, and I'd like to roll up my strikes. So I'm in a couple of these trades right now. Nvidia, I bought the shares back at like $85 or $90, and I started covering them at 130. Well, Nvidia's trading at 185. So I'm clearly I'm missing out on that $50+ of upside. But I'm going out in time and I'm keeping the 130 strikes, 130 strikes, 130 strikes, and I've added an extra couple $1,000s to my credits. But what I'm trying to do is if I go out far enough in time, I might also be able to roll up my strike. So from a 130 sell call, I can roll it up to 131 or 132, maybe even 135, and still get a credit. Okay. So I think rather than just like me saying it, let me give you an example. So I bought Nvidia at $90 during, this like March and April correction. Okay. And it was uncovered. I just established a position. Then price rallied aggressively. Previous all-time highs were the 150 to 153 zone. So I started adding at the money sell calls at 130 bucks. Okay. So I own 100 shares at 90. I sell a 130 sell call, let's say for a 45 days expiration for, 250 credit. I'll spitball the numbers here. Okay. Now my break even is 88.7, 87.50. Right. So I lower my cost and in turn increase my profit potential a little bit on the trade. Right. NVIDIA keeps climbing. Right. And the bullish rally. And hits, 150, 155, hits 170. Now it's up to 180. Unfortunately, I'm missing out on that gain. Okay. But what I'm able to do is rather than let the shares be called away, so that would be my sell call expiration at 130, the broker would take away my shares, right? If I don't do anything with them, they'll take my shares away. So what I'm going to do is instead, as I get into the final week of expiration, I roll my calls. And ideally, I roll out in time and up in price for a credit. I don't want to roll for a debit. Okay. Because eventually what happens is these notes are getting ridiculous, by the way. What happens if I roll it out for a debit, it's just going to increase my cost basis. If I were to roll it up like $10 and the broker's like, well, you can do that, but you're going to pay a $7 debit. I still make an extra $300, but I just increase my cost basis by $7. And I go from an 87.50 break even to now 94, right? 94.50. I don't want that. I want to keep my cost basis as low as possible. So basically I will do this repeatedly until it doesn't make sense to do it. So I own shares of the SPY. I own shares of the Qs. I own shares of Tesla. I own shares of MicroStrategy. I own shares of NVIDIA. I own shares of a couple other underlying assets as well. I'm continuing to roll these as long as it keeps making sense, right? If I can roll it out in time and I can roll it up in price and I can keep getting a credit, all that's going to do is increase my bottom line. So this is one of the biggest benefits to understanding options. Okay. And again, this is like pretty simple options where it's like you own something like shares and you're just trading options to lower your cost basis. If I bought the asset right here, let's say this is my NVIDIA. Okay. So I'll just draw this out. If I buy shares here, okay, the only way that I can make money if I just buy shares is what? How do I make money? The only way that I make money is if price goes up, right? So if I buy NVDA shares, the only way that I make money on that trade is if price appreciates. Okay. So if price appreciates, that's great. But what happens when NVIDIA is up $10 and then down $10 and up $5 and down $5 and up $20 and down $20? I mean, all sorts of stuff happens. You can sit in some shares for months and make $0. So I understand there's a trade-off here. It might not be perfect for me to buy shares in NVIDIA and sell a covered call. But if I were to sell an NVIDIA call, let's say, I don't know, $10 higher for $1.50 credit. Well, what this does is this allows me to capture that $10 price appreciation in addition to getting an extra $1.50 credit. So now my break even on NVIDIA is down $1.50. And if it gets called away, I'm going to make $11.50 in the trade, which is better than just getting the $10 if it goes up. Okay. Now, the best part about this is I understand that price has ripped higher. And you're like, well, Chris, you're just missing out on $50 of upside. I know this. You don't have to remind me that I missed out on the upside. Okay. But what I continue to do is if I can roll these calls, I can roll. So this sell call, I can then go out, towards the end of expiration here. I can now roll this call out in time for credit. Okay. And I can roll this call out in time for credit. I can keep doing this. And what I might not be able to do is I might not be able to roll for like a ton of credit. But if I can roll it out in time, keep getting more credit, it might be 50 cents. It might be $1. What that is doing every time that I extend the life of this trade is my break even is going lower and lower and lower and lower. The longer I extend this trade, the longer I keep the trade running, the longer I keep owning the shares, and I keep lowering my cost basis. So eventually, I know that NVIDIA's up to $180, but I could lower my cost basis. You remember that like 130 to 180? That's $50. Okay, that's $50 of upside that I haven't captured, but I could potentially lower my cost basis to below the April lows. Like I bought shares at like 90. I could lower my cost basis maybe down to like $70, $65, right? The chances of NVIDIA coming back to $65 are slim to none. And all I keep doing is I just keep this trade alive and I keep extending the life cycle. And maybe eventually I bring my cost basis down to $50 and prices trading at, 150. I have $100 of upside. All I have to do is, let go of it when I want to. But if I keep the trade alive, I keep extending the life cycle, rolling calls, and mostly it's time. If I roll it out in time for credits, then I just keep ticking away. And it's like just chipping away, discount, making this cheaper for me to own the shares. And Ozzy says, so as long as price doesn't run away, even if price does run away, I'm telling you, literally the stocks that I'm in right now, NVIDIA, okay? And look, if I had it my way, I wouldn't have covered it, right? Because NVIDIA's up to 180 and I'm break even but my break even is like $80. So, and like I said, in options, there's always a trade-off. I knew that when I put a covered call on, that could potentially cap my trade. I have to accept that. So if it doesn't make sense for me to keep rolling NVIDIA calls, which is like if I look to roll it and the broker says it's a debit, then I'm not going to roll it. I'm not going to roll it for a debit, increase my cost basis. So if it doesn't let me roll for a credit, I'll just let the shares get called away and I'll establish new positions. How do I establish new positions? Sell puts. Okay. Question. Do you think it's more volatile in your portfolio to buy shares of stock or sell puts? Which is more volatile? Buying shares. Absolutely. So if you want, and most people don't think this way. Most people don't think about risk. Unfortunately, don't think about risk because it's so easy to make money in a bull market. You don't think about risk. But if you focused your option trading on selling puts, this is like Warren Buffett 101. If you sold puts at 30 deltas or 25 deltas or 20 deltas, these are huge discounts. And that means you never chase highs, right? You never chase highs. I never want to buy stuff high. I know the S&P is at all-time highs. I don't care. I hate it. I hate that it's a highs. I want a discount. Okay. So when I'm selling puts or I'm doing ratio spreads or I'm doing all sorts of creative trades to like, I'm willing to own shares cheaper, discounted, not at highs. I hate the fact that we're sitting at all-time highs across the board on so many things. Mag 7 near all-time highs. Anything that's freaking AI related at all-time highs. We've had stocks that have ripped triple digits for the year. The S&P, the NASDAQ, and all. Everything. Even the Russell, even the little Russell has finally caught up. Everything's at all-time highs. It is designed to go higher. So it's not like I'm sitting here like, oh, I can't afford to buy these. I can. I don't want to. I don't think the market can go straight up forever. In fact, I know it won't. You all know it won't either. And at some point, when the market does fall, I want to be there patiently waiting to catch the discounts as opposed to chasing the frothy highs. So if you want to lower your volatility in the portfolio, sell puts instead of buying shares. If you are going to buy shares, think about the collar trade, because the collar trade at least gives you some upside appreciation by also protecting the downside. So, and this has happened from this year. I've had a handful of client accounts come in this year, and we already had a great run. Like all of my active clients that were in with me through the beginning of the year, we came out making a ton of profit through April, May, June, because I was participating aggressively through the sell off. But a new account that gets added in July or August or September, this thing's been like just in pure melt up mode. And I'm not going to establish a hardcore allocation at all time highs. So I'm trading a waterfall strategy too. I'm selling puts. I'm doing ratio spreads. I'm getting my trades where if I'm going to take assignment of something, it's way out of the way. Make sense? So you are constantly in a wheel strategy. In essence, yes. In essence, yes. But the wheel strategy, I mean, and again, the wheel strategy is you sell a put. If you get a sign, you get out of the trade with covered calls. The best part about a wheel strategy is if you are patient, you're going to lower your cost basis where you get a profit. So I look at a wheel strategy as a way to repair as well as generate income. Okay. So what's the trade-off? Why doesn't everybody do this? Well, because obviously I miss out on the upside. I started selling calls on Tesla at 350. Where's Tesla at right now? 430, 440, 450. Well, Chris, that's $70, $80 a share. I know this. So I've missed out on some of that upside appreciation. But I've lowered my cost basis on Tesla down to $212. Okay. Remember what the lows were back in April? Like 225. I've lowered my cost basis below the April lows when Tesla was down 55% from the peaks. So even though I am behind on my calls as far as I'm in the money on my covered calls, I've lowered my cost basis so much that it's actually below April lows. So yeah, I mean, if it goes up to all-time highs, that's fine. I'll just keep chipping away and I'll do this. I'm going to do what I just showed you here and just keep moving my cost basis down. If I can go lower and lower and lower and lower and lower the cost basis, eventually the price, it will stall and price will fall, but I'm still, in here with my in the money covered calls, and maybe it gets better and I just keep lowering my cost basis. So if there's something that I want in my portfolio, I like lowering my cost basis as much as humanly possible. So if it makes sense, I want to keep rolling out in time and if possible up in strikes so I can increase my net profit and also decrease my bottom line. So I can decrease the cost, increase my total take profit. And, perfect world is we don't ever sell a call that gets called away in a perfect world. But obviously price this year, we've had some aggressive price action in the market from the bull side has gone way, way higher. Make sense? So I'm just trying to create an income generating machine that allows me to pull in extra credit. And, when I say income, I mean, the reality is I'm not necessarily claiming the income. I'm not. Like the broker says, oh, sell call, we'll give you credit for that. Right. But what I'm actually doing is I'm tracking it based on my campaign trade. I own the shares. What's my break even? I sell another covered call. I roll that covered call. I roll another covered call. I roll another covered call. All I'm doing is chipping away at my cost basis. So I know that my net profit would be this. So I can do, if you buy shares here, okay, and let's say price goes up, okay, this would be your gain. So if you just buy shares and you close it, when price goes up $50, you make $50. Cool. Well, if I bought shares and I lower my cost basis, okay, and I lower my cost basis and I lower my cost basis and I lower my cost basis over time, and I still let the shares get called away at some point, there's a chance that my increase is actually as good or better. And the nice part about, trading options around your core positions is oftentimes we can keep pace, if not outperform, especially when markets go sideways and certainly when markets go down. We can keep pace. So if you lower your cost basis, you end up increasing the potential profit to the point where you're ready to let it go. And the trade-off is, yes, when the price runs aggressively bullish, you might get stuck where your calls are going to get called away. So you then have a decision. Do you want to let the shares get called away and you just start a new position? Or do you want to keep the shares by rolling the covered call out in time and just generating some income on that and lowering your cost basis. I like to do the latter. I like to roll the covered calls out for credits and decrease my cost basis and try to get these shares as cheap as possible. And inevitably, when I'm ready to let them go, then I get out of the position. Okay. And that comes back to, percentage allocations. And I mean, what's been good this year for me? A lot of stuff's been good. A lot of good income trades this year. Gold's been great. Silver's been great. Bitcoin's been fine. It's about to get better. I think Bitcoin's going to make all-time highs by the end of the year, so that's exciting. Anything in the S&P, anything in the NASDAQ, they've been fine. But I got in the money on all of them. I mean, I literally bought shares of the SPY, the Qs near the April lows. Within $10 of the low, I was in the SPY and the Qs near $10 at the low in April. That's how good the timing was on my entry. But once we got back up near all-time highs, I started selling calls, and the market didn't give a crap about those all-time highs. It blew right through them. So I've been in the money ever since, and I'm just rolling and rolling and rolling for income. Okay, but that does assume that you can also roll up. Not necessarily, Ozzy, because if I can't roll up in strike prices, I can still roll out in time, and I can still get credit. All these trades I can get credit for. So if I never increase my strike, I can still get credit, which decreases my cost basis. So I don't have, and sometimes you will see that if I try to roll it out in time and up in strikes, it won't let you. Or you can, but you're going to pay a debit for it. If I roll the strikes up by $1, the broker says, you got to pay us 80 cents for that trade. Well, I don't like to do that. I'd rather roll it out in time and just keep the same strike and get 50 cents or $1 on that roll. So I want to keep rolling for credit when I can. If it doesn't make any sense to do that, if I can't roll it out in time and keep the same strike for credit, or roll it out in time and roll it up for credit, if it's asking me to pay a debit, I'm usually just going to let the stock get called away. Case in point, like this week, I've got an expiration on Friday for Walmart. Okay. I've made a decision on Walmart. I'm going to let it get called away. I know I've got a lot of notes here. This will just be a good session to come back and review. I know these notes are a little obnoxious, but let me see. Let me do this. I'm going to copy this whole thing. So collar trade, a couple of examples. I'll put this in my notepad. And we'll do owning shares plus collar or covered calls and rolls. There. Now I've got the notes. So if we want to make reference to this, I got the notes right here. Okay. Now I can delete this stuff. All right. I was going to show you on Walmart. So if I go to WMT, go into my positions, Walmart is trading at 100. Ooh, this thing dropped like $3. Okay. Well, this is going to be really interesting because I have 2, 4, 6, 7. I have 1,000 shares of Walmart, and I have them all covered at $100. Well, I'm up $13,000 on Walmart. The reason that I'm happy to let the shares get called away is because I think Walmart has potential to pull back to $96, pull back to $93, pull back even to like the mid 80s. So if I let the shares get called away, I want to protect that $13,000 and then start establishing new income positions where if I own the shares, I own it cheaper. Because right now my break even on Walmart is, let me check. I go to Walmart. Break even is 85.15 on one account, 74.80 on another account, and 89.01 on another account. They're all covered at $100. So one's going to make about $11 a share. The other one's going to make about $26 a share. The other one's going to make about $15 a share. Cool. Okay, fine. So if I get it called away at 100, awesome. That has to stick around by Friday. If we're below 100, then the shares don't get called away, and I'll add another covered call. And I'll probably just keep adding the 100. But I wouldn't be surprised if we are back down here and oscillating. So if I'm just selling calls, what I am doing is I'm chipping away at my costs, which is fine. But if it gets called away, I'll just end up selling puts. That would be a pretty simple wheel strategy, which is I sell a put. If it gets assigned, I take the shares and I just start adding covered calls. Okay. I'll do this. Let me see if I can make this. Okay. Are these notes adequate enough for me to share on my Telegram? Obviously we can reference today's recording. It'll be posted in the YouTube channel, youtube.com/financial wars. This is a daily profit play session, but just an overview of today's discussion. Okay. So what I'll do is I will take a screenshot of this. Okay. So I'll just take a screenshot here. And I'll paste this in my Telegram. So if you have my Telegram channel, which all of you should, daily profit plan live session bonus education. We discussed lowering cost basis, protecting downside, and rolling trades. Notes in the image, and today's session on 10/1 will be archived on youtube.com/financial wars in the daily profit plan playlist. Okay, there you go. So there's notes. Now you have it. Okay. So Walmart, yeah, I mean, should be, but it's obviously hit. Here's the 100. There's the 100. There's the 100. I mean, we could hit the 50 and 100. We can keep this trade alive. I mean, I don't think Walmart's going to just tank. I mean, this is in a pretty strong bull trend. All I'm saying is, for me, $100 right here is an adequate covered call that even if price, drops a little bit, I'll still sell the 100. If price comes back above, I'll probably still sell the 100. I'm not trying to get too cute with like, I want to sell this call at 105. I mean, that's like the tippy top. That's the all-time high. So 100 is fine. And what I want to do is if I don't get it called away this Friday at 100, then what I will do is probably just add another covered call another 30 to 45 days out and just collect more income, lower my cost basis, and track that break even. But if it does get called away, so if it's greater than 100 by Friday and it gets called away, I am probably going to look at a trade like this. I'm probably going to go out to the end of the year and likely issue some, this is Liberation Day lows. I mean, if I can position for maybe like a 90 put and an 85 put and an 80 put, let me just see what that looks like right now. I won't place a trade because I don't want to like double and triple down on my positions. But if I went out to, December, January, and I do an 85, probably that. I mean, I can get $1.27 of income. Probability of profit is 90%. But yes, I would be tied up for shares if I get assigned. So what I could consider doing, and this is actually a pretty cool way to do it, and this is stuff I do in Project Options Edge. If I wanted to lower my deltas, then I would do a ratio spread. And this gives me an extra $1.67 to lower my cost basis, and I still pull in credit. And then I can do the 83 by 80. So this is interesting because I sacrifice about 40 or 50 cents. Is that right? If I did the 85 and the 80, I'm sacrificing like, 30 cents. But I'm essentially expressing the same trade. So I'm doing a ratio spread, which means I have an 86.67 by 85, and I want to own the shares at 85 if we're below that. And then I do an 83.33 and 80, and I own the shares at 80 if price is below 80. There's a 95% chance of profit. There's an income trade on here that if price stays above $85, I'm still making $95. But I'm willing to own 200 shares. So if I got assigned, I actually take the assignment, I get assigned, $85 and $80. So 85 and 80 divided by 2 is 82.50. Plus I get a credit of 94 cents. The half point is 47. So minus 47. I'd own shares of Walmart at 82.03 if I'm assigned. Okay, why is that important? Because at $82, I'd be back down to Liberation Day lows or very close to it. Now, this is not a high flying juicy premium stock. So owning shares at $82 does not mean I can just sell a call at 100 and get a lot of premium for it. If I own the shares at 82, I probably have to do like an $83 covered call, an $82.50 covered call. You know, if I'm lucky, maybe an $84, $85 covered call. This doesn't offer juicy premiums. But I would be much happier saying, if I'm going to own shares of Walmart, give me a discount. I don't want to buy all-time highs. So either this thing is, you know, this is our Liberation Day, support. I mean, maybe it just keeps doing this. Okay, fine. But I can make income here. And if it keeps going higher, I use my moving averages and I sell puts and I just buy the discount. You know, I don't ever feel like I have to chase. Yeah, if I had 200 shares, yes, it'd be 16.4 to own it. But I would be doing this probably on my margin accounts. Probably on margin accounts. Okay. Or if I really like Walmart, then I do a synthetic. So let's say that Walmart did drop to $80. Well, if it drops to $80, that would be like this. I would sell a put. I'd buy a call. It would cost me next to nothing for that trade. And I own it. It's like you're doing a synthetic to own the shares. Now, if I do a synthetic, I'm going out like to 1 or 2 years. I'm going to do like a leap if I like the stock enough. So I've got to be really, really happy with that position. Okay. Anyway. All right. You pay dividends for the next 2 quarters. For what? I mean, you pay dividends or get dividends? Walmart. Well, I'm not short. What are you talking about? I'm not short Walmart. Those puts that was a sell put. That's like owning it. I don't get dividends if I just have a sell put in. Yeah. The only dividends is when you own the shares. So I'd be expressing I want to own the shares, but if it's above it, I wouldn't benefit from the dividends. Okay. All right. There you go. Randy says just sold NVIDIA cover call 1017 expiration for $3. Cost basis 120. Awesome. Yeah. So, all right, check it out. We're up here for today. Good stuff. Good win. Price is, floating back up towards the open. We do have some resistance around that 90 handle. I don't know if we're close to getting filled on my bear call spreads. We got to be somewhat close for the day. If it's not filling, so where are we at? So pending orders. The call side, I've got a 67.05 and 10 traded for 60 cents right now. I mean, I'm going to let the trade sit. I'm hoping that we can't hit 67.05 today. If we do, I'd like to get filled for a winner. So I'll let this marinate. I mean, these trades are going to sit and pend. But we've got a winner on the daily profit play. That's fine. We'll come back and tackle tomorrow. If these get filled, great. I think they're all high probability trades. If we get filled, then this should be a good winner. Okay. Good stuff on today's session. Hope so. And today at 1 p.m. Eastern time, let's do pinch point scanner. So if you're in my pinch point scanner, have the dashboard. I'll do a live trading session at 1 p.m. today. Okay. And then Project Options Edge going live on Friday afternoon, 1 p.m. Eastern time for a full on crash course strategy session. It's going to be like a Project Options Edge boot camp. And we'll review all of our current positions. Okay. All right. Daily prof play, nice winner today. Waterfall, we took a trade on Monday. We've had master classes in Waterfall a lot the last couple of weeks. Daily prof play a lot the last couple of weeks. And just here to offer some help, services to help anyone, whatever you're looking to do. You want to trade short-term, medium-term, long-term. You want to learn a variety of strategies. All I keep saying is if I can teach you options, what I'm hopefully opening your mind up to is whatever you want to accomplish in the market, whatever you want to express in the market, you can do it with options. I want to be bullish. There's a handful of strategies. You want to be bearish? There's a handful of strategies. You want to generate earnings trades? There's strategies. You want to take advantage of neutral price action and volatility? There's strategies, right? Up, down, or sideways, you can literally position with an option strategy. Do you have to be, the master of all of them? No. But having a couple tools and a couple strategies to add to your arsenal of, well, at least I know if I want to be bullish, I can trade this. I want to be bearish, I can trade this. I want to be directionally neutral, I can trade this, right? Or owning something, lowering your cost basis, increasing your net profits, that certainly helps too. Okay. Ozzy said earnings. Earnings, then yeah, jump into newsbreakers. If you want to trade some earnings with me, we do a lot of earnings trades. It's coming up here in the next week or two. We'll have a lot of earnings trades as we heat up here in the next week. Okay. All right, good stuff. Okay, we'll come back to do it again tomorrow, 1 p.m. for Pinch Point today, and I'll see y'all soon. Thanks, bye.